The radio clicks on before the kettle finishes boiling. A burst of static. Then a man's voice, tight and fast, speaking over the low hiss of morning news in Buenos Aires. Elena stands barefoot on the kitchen tile, one hand wrapped around the chipped handle of a blue mug, the other still resting on the dial. Outside, beyond the balcony doors, the courtyard is waking up. A dog barks once. Someone drags a metal chair across concrete. The orange trees are still wet from the night air. Then she hears the word, corralito, little fence. She does not sit down. The coffee keeps dripping into the filter. Dark, bitter, slow. On the table beside her is a leather envelope holding bank receipts, withdrawal slips, neat columns of numbers she has guarded for years, with the discipline of a school teacher who knows what it means to build a life one careful month at a time. $17,000, not pesos, dollars, safe money. Or so she thought. The announcer keeps talking. Limits on withdrawals, emergency measures, temporary controls. Temporary. That word has ruined more ordinary people than panic ever did. By noon, Elena is standing in line outside the bank with pensioners, shopkeepers, office clerks, mothers holding bags too tightly against their sides. Nobody is shouting yet, but nobody is blinking much either. And here is the question that matters. What if the most dangerous asset in a currency crisis is not the risky one? What if it is the one that looks responsible right up until the morning the doors do not really open anymore? The line does not move for a long time. A security guard shifts his weight near the glass doors. He does not look at anyone directly. Inside, the lights are on, but the desks sit half empty. A printer hums somewhere in the back. Elena watches a man in front of her unfold a newspaper, then fold it again without reading. The headline is already old. Limits, controls, stabilization. Words like that always arrive clean, clinical, as if they belong in a textbook, not in the middle of a street where people are counting what they can still reach. This is the part most people misunderstand. They imagine a financial collapse as something loud, sudden, a break. One day everything works, the next day it does not. But when you study enough of these events, Argentina in 2001, Germany in the early 1920s, Zimbabwe in 2008, Lebanon in 2019, you start to notice something else. It rarely breaks that way. It stretches first, quietly. A government spends more than it collects. That gap is not unusual. It happens everywhere. At first it borrows. Bonds are issued, investors buy them. The system holds. Then borrowing becomes heavier, more expensive. Confidence thins, not all at once, but enough. And then comes the easier step. Money is created. Not physically at first, not something you can hold. Just numbers, expanded balances, increased supply, liquidity added to keep the system moving. On paper, nothing looks broken. Salaries are paid, accounts still show growth, interest still accumulates, but something underneath has already shifted. If you double the number of currency units in circulation without doubling the real goods they represent, each unit carries less weight. The numbers stay the same. The meaning does not. This is what economists call debasement. It does not announce itself. It accumulates. In the United States, since the decision by Richard Nixon to suspend the dollar's convertibility into gold in 1971, the purchasing power of the dollar has eroded steadily over decades. Not destroyed, not collapsed. Eroded. Quietly. The kind of change people adjust to without marking the exact moment it began. And that is the mechanism that matters. Because when the pressure built by that slow erosion becomes too large, when debts cannot be serviced in real terms, when confidence thins too far, the system does not simply stop. It looks for containment, withdrawal limits, forced conversions, redenominations, asset freezes, controlled access. Not chaos, control. And the people most exposed in that moment are almost never the reckless ones. They are the ones standing in line, holding documents, waiting for a system to honor what it promised. The door opens a few inches, then stops. A hand appears. Papers are taken, stamped, returned. The line inches forward not because the system is working, but because it is being controlled. This is where the pattern stops being abstract. Across a century of financial history, the same categories of assets fail in the same way. Not because they are volatile, but because they are tied too closely to a currency that is losing its meaning. Category 1. Long-term government bonds. The promise that keeps its form and loses its value. A bond is a contract. You lend money to a government. It promises to pay you back, principal plus interest over time. Fixed schedule, fixed amounts, clean, predictable. That predictability is the trap. In the early 1920s, citizens in Germany purchased war bonds in large quantities. Teachers, clerks, shop owners, ordinary people. The bonds were framed as patriotic, but also safe, backed by the full authority of the state. The payments came exactly as promised, on time, in full. And by late 1923, they were functionally worthless. Not because the government defaulted, it did not. The bonds paid in German marks just as agreed, but the mark itself had collapsed under the weight of post-war debt, reparations from the Treaty of Versailles, and aggressive money creation. A loaf of bread reached prices measured in billions. The bondholder received his payment. He could not buy bread with it. Cause to effect to mechanism. Cause excess debt plus monetary expansion. Effect. Currency loses purchasing power. Mechanism. Bond payments fixed in nominal terms leads to real value collapses. A bond does not protect you from currency risk. It locks you inside it. Category 2. Cash savings. The illusion of stability. Cash does not fluctuate on a screen. It does not spike. It does not crash. It just sits there. That is why people trust it. But cash is not value. It is a claim on value, denominated entirely in the currency system itself. In 2008 in Zimbabwe, the central bank issued a $100 trillion note. It looked official, crisp ink, formal design. It could barely buy bread. Nurses, teachers, civil servants, people who had saved carefully in bank accounts, watched balances grow larger in nominal terms while their purchasing power evaporated hour by hour. Prices changed between morning and afternoon. Salaries were spent immediately, not out of panic but necessity. If money loses value faster than it accumulates, saving becomes a losing equation. The same mechanism appeared again in Venezuela. The government removed zeros from the currency, reissued it under a new name, and declared stability. Within months, the process repeated. Cause to effect to mechanism. Cause, rapid increase in money supply. Effect, hyperinflation. Mechanism, cash retains nominal value leads to loses real purchasing power. Cash feels safe because it does not move. But in a debasing system, the danger is precisely that it does not move. Category 3, fixed pensions and annuities. Stability that turns into a trap. A pension is a promise stretched across time. You contribute for decades. In return, you receive fixed payments in retirement. Predictable, structured, secure on paper. In practice, during currency collapse, that structure becomes rigid at exactly the wrong moment. In Weimar Germany, retired civil servants continued receiving their pensions throughout the hyperinflation. Payments were not missed. The system did not fail administratively. It failed economically. A monthly pension that once covered rent, food, and basic living expenses eventually could not purchase a single egg. Not because the number changed, because the currency did. The pensioner was locked into a fixed income stream while prices moved freely upward, faster and faster, breaking the relationship between income and survival. Cause to effect to mechanism. Cause, inflation outpaces fixed income. Effect, real income collapses. Mechanism, payments fixed leads to prices variable. A fixed pension assumes a stable currency. Remove that assumption, and the structure collapses in real terms while remaining intact on paper. Category 4, bank deposits. Access that can be restricted or redefined. The line moves again, one step. Inside the bank, everything appears organized. Desks, computers, staff. The system has not disappeared. It has changed behavior. Bank deposits are often seen as the safest form of money storage. Liquid, accessible, insured up to a point. But beyond certain thresholds, depositors are not owners of money. They are unsecured creditors. This distinction becomes real during crises. In 2013, in Cyprus, depositors with balances above 100,000 euros faced direct losses. At the Bank of Cyprus, nearly half of those deposits were converted into equity. At Laiki Bank, large deposits were wiped out entirely. No warning in advance. No opt-out. In Lebanon, depositors holding US dollar accounts discovered that access to those funds was restricted. Withdrawals were limited. Eventually, dollar deposits could only be withdrawn in local currency at official exchange rates far below market value. The number on the statement remained. Its usability did not. Cause to effect a mechanism. Cause, Banking system instability plus capital controls. Effect, restricted access or forced conversion. Mechanism, deposits become liabilities of the bank, leads to subject to policy changes. A bank account is not just storage. It is a relationship with an institution operating under a legal framework that can change. Category 5, total system exposure. When everything you own depends on one currency. This is the most important category and the least visible. Individually, each asset, bonds, cash, pensions, deposits, has a role, a function, a justification. But when all of them are held within the same currency system, under the same legal structure, tied to the same underlying promise, they become one thing, a single point of failure. In Argentine economic crisis 2001, accounts denominated in US dollars were forcibly converted into pesos. The government set the rate, then the peso was devalued. The system did not collapse outward, it redefined inward. People who believed they had diversified, cash, savings accounts, fixed income instruments, found that all of those assets were exposed to the same underlying mechanism. Currency risk, legal risk, systemic risk, cause to effect to mechanism. Cause, currency peg breaks plus policy intervention. Effect, forced conversion plus devaluation. Mechanism, all assets tied to system leads to all affected simultaneously. Diversification inside a single system is not true diversification. It is variation within the same constraint. The pattern repeats. Different countries, different decades, different political systems, same structure, same outcome. Assets that appear safest because they are stable, predictable, and widely accepted become the most vulnerable when the system that defines their value begins to change. And it does not announce that change loudly. It tightens access, adjusts rules, redefines terms. One step at a time. By mid-afternoon, the line outside the bank has changed shape. People stand closer now, not speaking much. A woman counts notes in her hand, then counts again. A man steps out of line to make a call, comes back, takes his place without asking. No one argues. Not yet. This is how these events echo across time. Different languages, different currencies, different governments. But when you place them side by side, the structure lines up almost too cleanly. In the early 1920s, Germany saw its middle class eroded through hyperinflation. Savings dissolved. Bonds paid out in numbers that no longer connected to real goods. The system did not seize accounts directly. It let the currency do the work. In 2001, Argentina used a different method. The currency peg broke. Bank access was restricted. Dollar deposits were converted. The loss was not hidden in prices. It was enforced through policy. In 2008, Zimbabwe pushed the mechanism to its extreme. The currency itself lost all functional meaning. Transactions shifted toward foreign money and barter. The system didn't tighten, it disintegrated. In 2013, Cyprus introduced something else: direct depositor involvement. Large accounts became part of the bailout structure. The system did not collapse. It reached inward and redistributed losses. And in 2019, Lebanon blended all of these elements: restricted withdrawals, dual exchange rates, de facto conversion of dollar deposits into a weaker local reality. Not one mechanism, several layered together. 5 countries, 5 different approaches, same pressure. When a financial system reaches the point where its promises exceed its capacity, it does not choose a single path. It uses whatever tools are available, monetary, legal, administrative, to close the gap. Sometimes the currency absorbs the shock. Sometimes the banks do. Sometimes the depositors do. But the direction is consistent. The system adjusts inward before it breaks outward. And the people most affected are almost always the ones whose assets are fully contained within that system, no matter how safe those assets appeared beforehand. The bank door closes again, just for a moment. A quiet signal, more than a barrier. No announcement, no explanation, but everyone in line feels it. The shift is subtle. Access is no longer assumed, it is granted. That is where the lesson begins. Not in prediction, not in fear, in structure. Across every case, Germany, Argentina, Zimbabwe, Cyprus, Lebanon, the outcome did not depend on intelligence, discipline, or effort. The people who were most affected had all 3. What mattered was exposure, not how carefully they saved, but what system their savings depended on. First principle: value is not the number. It is what the number can reach. A balance on a statement is static. The world it interacts with is not. When that relationship breaks, through inflation, conversion, or restriction, the number becomes informational, not functional. Second principle, contracts inherit the weakness of the currency they are written in. Bonds, pensions, deposits, they are not independent protections. They are structured promises, and if the underlying unit of account weakens, the structure holds, but the outcome shifts. Third principle, liquidity is conditional. Access to money is not a permanent right inside a financial system. It is governed, legally, operationally, politically. Under stress, access can narrow long before value disappears. Limits come first, then rules, then redefinitions. Fourth principle, diversification inside one system is not true diversification. Holding multiple financial products within the same currency framework, accounts, bonds, funds, creates variation, not independence. When the underlying system is stressed, those variations tend to converge. Different forms, same exposure. Fifth principle, systems adjust before they collapse. They slow withdrawals. They alter exchange rates. They change terms. The transition is rarely a single moment. It is a sequence. Recognizing that sequence early is not about reacting instantly. It is about understanding what is changing and what is not. These are not instructions. They are observations drawn from repetition, patterns that appeared whether people expected them or not. And once you see them clearly, you begin to notice something else. The risk is not always where volatility is. Sometimes it is where stability appears unquestioned. By evening, the line is gone. The street looks normal again. The same trees, the same balconies, the same quiet hum of the city settling into night. Elena sits at her kitchen table with the radio off now. The mug is empty, cold at the rim. The envelope is still there, but she does not open it again. Nothing has visibly collapsed. The numbers still exist. The system is still standing, and yet something fundamental has shifted. What you have seen is not a prediction. It is a pattern, one that has repeated across countries, decades, and entirely different political systems. Germany, Argentina, Zimbabwe, Cyprus, Lebanon. Different names, same structure. The most dangerous position was never risk-taking. It was certainty, placed entirely inside a system that could change the rules. So before you look at your balance, your plan, your sense of security, pause for a moment and ask a quieter question. Not how much you have, but what that having actually depends on. Because the difference between those two things has rewritten millions of lives. Without warning, without noise, and often without a single broken promise. If this way of looking at history changes how you think, then it has already done its job. And if it stays with you longer than this moment, it may do something more.